Hello everyone. I want to spend some time going over some of these examples of applying present value to calculating the fair value of some of our assets or liabilities, because they can apply in either case. So we're going to go back and forth between the questions or the problems you were given here, as shown here, and Excel, where I've done some of the calculations to show you how you might do those. So we'll start with the first one here. Following bonds were issued by Margolis Company. If you issue bonds, that means you're borrowing money. They're going to have to be paid back entirely in 20 years. That's maturity. Interest is paid at the coupon rate. That's the actual amount of cash that's going to transfer from Margolis Company to whoever loaned them the money, whoever bought the bonds. The maturity value, they're going to have to pay off $8 million at the end, and the market rate or the yield to a maturity rate, or the amount that is issued to yield, is 5%. That's what other bonds of similar quality and risk are paying. So we're paying just slightly less than the market rate in this case on these bonds. So how are we going to calculate that? We're going to first figure out the payment. So we take the $8 million. Bond payments are always calculated by multiplying the face value times the coupon rate, which in this case was 4.7%, and then divide by 2 because bonds pay semi-annually. So the face value is $8 million. The payment every 6 months for 20 years will be $188,000. So that's what we're going to pay. We're going to pay $188,000 every 6 months for the next 20 years, and we're going to pay $8 million back at the end. So what is that worth today? What's the present value? So we're going to use the present value formula. We're going to use the market rate, the 5%. We already used the 4.7% to calculate this payment. We will not use that rate again. So we use the 5%. Because we're doing on half-year payments, we're going to divide that by 2. So it's really 2.5% per 6-month period. That's going to happen 40 times. Those payments are going to happen 40 times. So this is the interest rate, then the number of payments, then the amount of the payment, which we calculated earlier in B2, okay, here, and then finally the amount that we're going to pay back at the end. So you could do present value of the payment and then the present value of the maturity value separate and then add together, but you can do it all together in the formula this way. This takes the present value of each of these payments and the present value of this $8 million at the end, adds it together, and we get the $7,698,767. That's what we could sell these bonds for. That's our value, the present value of those future payments. That's what the buyer would pay us. That's what we could borrow, given that we promised to pay back these amounts that we discussed. So that's how that could be applied. Now, the next one is a loan scenario. We've got buying a building, costs 4.3. We're going to put $500,000 down. We got an interest rate at B&B Bank for 4.5% per year for 20 years. Okay. So what we're going to do, that leaves us with a loan of $3.8 million after we take off the down payment. We're going to ignore closing costs and all the other kind of stuff. 4.5% interest per year, and that's going to be 20 years. So first we're going to figure out the payment if we made one payment per year. So we're going to use the PMT formula. That's what we find out what the present value of these payments will equal this. But since you know, don't know the payment at the start, you can't do it quite that way. You have to use the PMT. It's using the same calculations as the present value function. It's just doing it backwards. So PMT, and then we're going to say that the rate is 4.5%. The number of periods is 20, number of payments, and then the amount is going to be the 3.8 million. And that will give you a payment of $292,129.35 per year. Now what if we change the terms? Not the annual interest rate, but we change how often the payments are made. So we change the formula in this following way. Instead of PMT and then the interest rate, we take interest rate and divide it by 4, right? Because it's going to be 4 payments per year. And then we take the number of payments and multiply it by 4. So whatever you're going to divide by here, you're going to multiply here. So whatever, if you're going to cut the time period down to a quarter of the year, you're going to have 4 times as many payments. And then the amount of original loan amount is the same on that one. So if you made 4 payments a year, you would pay $72,288 every 3 months. And then if you did every month, you divide by 12 and multiply it by 12 to get the monthly payment. So you'd make $24,000. Now if you multiply these out and you say this times 12 and this times 4, okay, you'll see that you actually pay less if you make payments more often, because you get to reduce your principal faster. So you pay less interest. And that's, of course, why most of your time banks will require monthly payments rather than annual payments. All right, so that you, and you're just more likely to pay them that way. Most businesses work best on a monthly payment. All right, so moving on to our next one. Right now, purchase a large piece of equipment from Arcsoft. Okay, so right now it's going to buy the equipment from Arcsoft. It's going to pay $50,000 right now, and the equipment is going to be delivered. So they're going to get the equipment. They're going to pay $50,000, and then in 2 years they're going to pay another $350,000. So a total of $400,000. The $50,000 happens right now, so that's worth $50,000. But $350,000 is in 2 years. And we have to consider interest on that because the normal borrowing rate is 9%. So how is that going to work? Well, we first have to figure out what the present value of this future cash flow is. It's $250,000. So using our present value function, we go for 9% per year. It's 2 years out, and the amount is $350,000. Now notice in here there is 0 payment. It is not, there's not a series of payments. This is a single payment at the end of 2 years. If it was a payment next year of $350,000 and then the $350,000 at the end, then you would put that as the amount of payment instead of as at the end. So if you look at how this is structured in the function, 0 is the payment and the future value is the $350,000. If it was 2 payments of $350,000, the $350,000 would go here and the 0 would be here. Okay? So it's an important distinction there as to what the payment is, whether it's the future value lump sum at the end or it's a equal payment through the course of the loan. Okay? All right. So what we find out is that that 350,000 is really worth 294,588. That's the present value. So when looking at the journal entries, Arcsoft, okay, or right now, let's talk right now, purchases it. So they're going to pay 50,000 plus have a loan payable of 294,588. So they're going to credit cash 50,000, credit a loan payable 294,588, and they're going to have an asset of the total together of 344,588. So adding the amount of the loan plus the 50,000, that's what they're going to use to calculate depreciation. All right, and that's what they're going to record on their balance sheet as for the asset amount. Now, on the other side, Arcsoft is going to have sales revenue, if you will, of the 294 plus the 50,000. They're going to get cash, debit cash 50,000. They're going to debit accounts or note receivable 294,588 and credit sales 344,588. So they should be mirror images of each other, those journal entries between the two companies. Now, what happens after 6 months? The interest, no payment gets made, because no payment gets made until the end of 2 years. But meanwhile, there's interest being accrued. So for the company who bought the equipment, they're going to debit interest expense and credit interest payable or loan payable for $15,465.87, and seller, the one that sold the equipment, is going to have interest receivable or note receivable that's going to be debited $15,466 and credit the interest revenue. All right, so now that loan on both sides is up to 310. That's how much is totally owed after 6 months. Then we do interest for the whole year on the new 310. So now it's going to be interest calculated on 9% on a whole year for 310. Journal entries are going to look very much the same. We're going to debit interest expense and credit interest payable for the one that bought the equipment, and we're going to debit interest receivable or note receivable and credit interest revenue for the seller. Now the new balance that's owed between the two companies is $337,958, and then we have another 6 months of interest. So this is 2 years, half a year, full year, and another half a year for a total of, well, it's not quite, this is, remember this is 7 months, so I didn't use half the year, I did June through December, so that's 7 months here, that's 5 months here, this is a full year. All right. Add that, and notice it doesn't come out to be exactly the 350,000, which is what we used originally, because we did this as a 2 year, and we actually have here what compounding 1, 2, 3 times instead of just 2 times. So we get a little bit off by $632 of interest in that last year. So that's how your journal entries and how you would record that on both sides, the purchase and the sale. Now the last one, if we look at this, is we're going to purchase another business. Cost of capital is 12%. Because we buy this, there's going to be different cash flows. So first of all, the cash flows are going to increase by 10% each year, and then they're only going to increase by 5%. So this is not the same amount every year. So we're going to kind of have to schedule out. In 2016, it's going to bring in this cash flow. Next year, that cash flow and so forth. And to do an increase, you just multiply by 1.1, and then when the increase is 5%, you just multiply by 1.05. And you just have to schedule out all the years, because each one of them is different. You can't just you can't skip a step here. You have to have each year listed and the amount. And then you're going to do net present value utilizing the 12% as the rate, and the values are all of the cash flows. And this will give you the present value of each of these cash flows as of today. So this is what you would be willing to pay for that chain of stores, because that's what the future cash flows are worth. So when you look at that situation, that's what you would pay. And then our question was, what should we be willing to pay for that? Last, we have some consideration of the fair value hierarchy. Municipal bonds. Okay. You notice that there is, in this municipal bond, they say they're using level 1 fair value, but that means you can look it up in a regular market. That does not seem to be what's actually happening. Matrix pricing is something that is we're from a negotiated market, no central exchange, best bid or offer available, use of educated appraisals made by these scenarios. So we're using other bonds, negotiated market, to price these bonds. So when that is the case, then, and it's not a direct look up the value price, that this is actually a level 2. Okay, so not a level 1, even though they were talking about it as if there was. And then the broadcast license, but this is external, so it's still an external, something you can measure outside the company. That's what makes it not level 3. Now on the last one here, you're going to look at the value of this broadcast license based on the value, how much it's going to save the company using discounted, that means present value cash of the future cash flows. So you're going to figure out what cash flow are going to be, or what you predict they're going to be going forward. You're going to take a present value of those, like we've practiced, or a net present value if the cash flows are different every year, to come up with this very much the same way as we did with this acquiring of the new chain of retail stores. Kind of the idea of what would you pay for this broadcast license if someone was trying to sell it to you. And you want to make sure that the value you pay is equal to the future cash flows. And to do that, this means that it is, because it would be completely internal. There's no other exactly licensed like this or even similar that we could use. We are using level 3, where we're taking our assumptions, our estimates of future cash flows, and applying interest rate, present value techniques to get the value and to test for impairment. Okay. So, especially since there's a change in the situation because of the recession up there in the Great Northern Territories. So definitely going to need to revalue this using level 3 fair value.